Learning objective number 3 is consolidations. Here we see what would happen in our example if Google acquired 50% or more of another company. The footnote in Google's financials has this basis for consolidation. The consolidated financial statements include the accounts of Google Inc. and our wholly owned subsidiaries. All intercompany balances and transactions have been eliminated. So the last part means that if a subsidiary sells products to Google, it can't count that as a sale. We would be double counting sales because the subsidiary sells to Google and Google then sells it to somebody else. So we're getting 2 sales for the same product or service. So that's not permissible. So we do what we call a consolidation elimination, where we take out all the intercompany sales between subsidiary and parent. The balance sheets include 100% of all the assets of both the parent and the subsidiary, again, after eliminating these intercompanies. And the only thing we have to adjust for is if we don't own 100%. If we own 51%, we'd have to reflect that we count 100% of the assets and liabilities, but we have to show that there's a minority interest, otherwise called a non-controlling interest, that is part of the equity. On the income statements, it's very similar. We count 100% of the revenue and expenses, but again, we don't own all the net income. Some of that belongs to the minority shareholders. So in the very bottom, after we determine the net income, including the non-controlling interest, we have to subtract that out as well. We have to subtract out the income from non-controlling interest before we get to the bottom line, which is net income attributable to the company. The consolidation, here are some examples from the most simple to most complicated. The first is where it's 100% owned and you bought everything at book value. Here we have Penman is the buyer and Nissim is the smaller company that got acquired. We'll see here in yellow that there was $3,400 paid by Penman to Nissim, and here we see that that was equivalent to the book value of Nissim. When we do this consolidation adjustment, we wipe out this investment account and we add up all the book value items in assets and liabilities, and we eliminate the equity section of Nissim. So the end result shows, look at how it works. The current assets includes both together. The investment in Nissim goes away to 0 because we've consolidated. And the PPE is the sum of PPE between the 2 companies. So that's $14,000. Liabilities is $5,000 for Penman plus $2,000 for Nissim, total of $7,000. Contributed capital only includes the capital for Penman, which is the surviving company. Income statement, likewise, we show all the revenue expenses for Nissim added with Penman, but so we eliminate this equity income to be 0. All right, so what happens if we own less than 100%? So same companies, except this time there is this non-controlling interest. So the same entries for the investment, the eliminations for the investment account and equity, but see the 680? This represents the amount of minority interest that remains in Nissim. So we show that it's a minority interest in the consolidated entity, and it shows up in the bottom line for the company. And so this is where we see the creation of the balance sheet and income statements that show non-controlling interest. And finally, the example where we have 100% owned, but we bought at more than book value. In that case, we bought Nissim, but we paid a lot more money for Nissim than the book value. And in this case, we show consolidation, and there's this item called goodwill on the books of the parent company, and this reflects that the parent paid more than the fair value of the assets for the subsidiary, in this case Nissim. Generalizing on acquisition accounting, the purchase price paid between the buyer and seller first goes to all the known assets that we bought, and they're valued at fair value. And then we reflect all the liabilities that were absorbed by the parent, also at fair value. And anything that's off, we then first look at, are there intangible assets that we bought and we can identify? Some examples of these intangible assets might be marketing things such as the value of the trademark or domain names, customer items such as customer lists or contacts, artistic, which is the works, the intellectual property like plays, books, and videos, contract-based assets where there may be existing contracts in the acquired company that have higher value than what they paid for it, and certainly more value to the acquiring new parent. And the technology, this is R&D, it's patent portfolios, and there's an item called in-process research and development where it's not finalized, it's not a granted patent, but it looks very promising. So what if the larger company bought the smaller company, because this in-process development is very promising? Some of that value would be assigned also to this area of in-process development. Let's say that the amount paid exceeds all the fair value of identifiable assets, all the value of these identified intangible assets. Now what do you do with it? Answer, you put it on an account called goodwill. In accounting, we call it a plug. It means that we just need that to total, such that the total of what we bought equals the total of what we paid. And that is not very elegant, but that is what goodwill represents. In the example of Heinz acquiring Kraft, the purchase price was $52 billion. And they went through the acquired assets. They saw cash, current assets, PP&E, and these are all kind of known quantities. Then in blue, we see identifiable intangible assets, and that's that list we saw on the bottom with the trademarks and the trade name, etc. Then we had other non-current, and then when we got to the very bottom, you see that the net assets acquired were $23 billion, and yet they paid $52. So what's the other $29 billion, which is more than the total value of all the identified assets? That's all goodwill. So these are the items that will comprise goodwill for Heinz going forward, and by GAAP, they will review it every single year and see if the assets they acquired from Kraft is still worth $29 billion. The accounting for Heinz, subsequent to this, they'll have to look at the intangible assets, and if they're indefinite lives, then we will leave it alone. But if there is a defined lifespan, such as customer relationships, they may estimate how long those will be valuable and amortize those intangible assets over that life. And the items that are goodwill are subject to what we call annual impairment tests to see if the value has declined in that time frame. Financial statements and consolidations. Most companies have consolidations, so it's complicated because the underlying accounting is not as clean for us to tear apart because we put all the numbers together. Occasionally, companies may disclose great amount of details of subsidiaries and their lines of business. However, that's a little bit at the discretion of the companies. We often are dealing with incomplete information. It's accurate, but incomplete. Summarizing Module 9, intercorporate investments, we have first passive investments, which are where there's minimal influence, namely under 20%, and they're recorded at the fair value, and we mark to market at the balance sheet dates. And for bonds, and only bonds, we have the ability, if the company chooses to, deem them as held to maturity, in which case we hold them at cost and only make adjustments for the actual premium or discount at the time of purchase. The second group is equity investments, and these are 20 to 50%. These are the ones we do the kind of unusual accounting where we record it at cost, and then we bump up the investment account when the investee declares that they made income, and we take down the investment as the investee pays us cash dividends, and we reduce the amount of our so-called net investment by the amount of dividend we received. And finally, consolidations is where the company owns 50% or more, and we consolidate the results of those smaller companies, the subsidiaries, in with the parent at 100% of assets, liabilities, revenues, and expenses. And the correcting feature for those where we're not wholly owned is this item called non-controlling interest. And those exist on both the balance sheet and also the income statement. So that's it for Module 9, and I will see you this week. Thank you. Bye-bye.